Guess what? I discovered an uncommon video of Charlie Munger revealing his 3 key tactics for securing 50% annual profits with small investments. Even with its iPhone 4 resolution, Munger's wisdom is priceless. For anyone seeking financial growth, it's essential viewing. While most claim you need capital to gain capital, Munger feels you don't require a vast sum to see remarkable gains. Let's explore the video.
Warren and you are known for saying that if you work with a small sum of capital, namely I think being $10 million, Warren had published that he could guarantee that you compound that at 50% a year. So my question is, can you provide some examples? And I would kindly ask you to provide as many examples as possible and be as specific as possible. Thank you.
Well, and then I hear somebody that really wants to get rich at a rapid rate with specifics. That is not what we try and do here. We want to leave some mystery so that you can amuse yourself finding your own way. You know, the good ideas that I have had in my life are quite few. But the lesson I can give you is a few is all you need, and don't be disappointed. And when you find the few, of course, you've got to act aggressively. That's the Munger system. And I learned that indirectly from a man I never met, which was my mother's maternal grandfather. He was a pioneer, and he came out to Iowa and fought in the Black Hawk Wars and so on. And eventually, after enormous hardship, well, he was the richest man in town, and he owned the bank and so on. And he sat there in his old age when my mother knew him, because she'd go to his Algona, Iowa, where he lived and had the big house in the middle of the town, iron fence, capacious lawns, big barns. And what Grandpa Ingham used to tell her is there's just a few opportunities you get in a whole life. This guy took over Iowa when the black topsoil of Iowa was cheap. But he didn't get that many opportunities. It was just a few that enabled him to become prosperous. He bought a few farms every time there was a panic, and he leased them to thrifty Germans. He couldn't lose money leasing a farm to a German in Iowa. But he only did a few things. And I'm afraid you're not going to find a million wonderful ideas. These people, the computer algorithms do it, but they have a computer that's sifting the whole world. It's like placer mining. And of course, every niche they're in, if somebody else comes in, the niche starts leaching away. And I don't think it's that honorable way to make a living, by the way. I would rather make my money in some other way than outsmarting the trading system, so I have a little computer algorithm that just leaches a little of everybody's trade. I always say that those people have all the social utility of a bunch of rats in a granary. It's not that great a way to make money. I would say that if you make your money that way, you should be very charitable with it, because you've got a lot to atone for. and so I don't think it's an ambition we should encourage. And the rest of us who aren't just leeching a little off the top because we're great at computer science. And that's what this room is full of. And if you're not finding it harder now, you don't know.
Charlie Munger, the vice chairman of Berkshire Hathaway, has long been a beacon of wisdom in the investment world. With Berkshire Hathaway's market cap nearing a staggering $800 billion, it stands as the 9th largest global company by market cap and the top non-tech US-based entity. The sheer magnitude of Berkshire might seem like an investor's dream, but Munger and Warren Buffett, the company's chairman, have often expressed the opposite sentiment. They believe that the company's vastness hinders its potential for high investment returns. Why? Because with such a colossal capital, they are compelled to chase only the most significant investment opportunities, which are rarely mispriced or, in investment parlance, inefficient. This is where the first principle comes into play: the allure of inefficient markets. Large-scale investors, such as Buffett and Munger, are often too engrossed in grand opportunities to notice the smaller, potentially more lucrative ones. This is where individual investors can find their niche. In the past, Munger and Buffett had to sift through countless financial reports to unearth a single viable investment idea. Today, thanks to the internet, identifying undervalued stocks has become considerably more straightforward. Using basic stock screeners, one can filter companies by market cap and PE ratio, portfolio, targeting those that are overlooked by Wall Street due to their size. Many professional investors, bound by regulations, cannot invest in companies with a market cap below a certain threshold, leaving a plethora of potential investments unexplored. Contrast this with a giant like Apple, which is scrutinized by 31 Wall Street analysts. Smaller companies, often ignored, present a golden opportunity for discerning investors to identify stocks trading below their true value. Before delving into the second principle, it's worth noting the immense value of learning from investment maestros like Munger. Their insights have transformed many an investment trajectory, and sharing their wisdom can only benefit the larger community. The second principle is simple yet profound. When a golden opportunity presents itself, seize it with both hands. Such opportunities are few and far between, so they must be capitalized upon. This can be best illustrated with a baseball analogy. In baseball, the batter's objective is to hit the ball to score runs. Ted Williams, one of the sport's legends, emphasized the importance of patience in his book, The Science of Hitting. By waiting for the perfect pitch, a batter can significantly increase his chances of scoring. This principle is mirrored in investing. Investors are bombarded with myriad investment options daily. However, only by patiently waiting for the perfect opportunity, one that aligns with their investment strategy, can they hope to achieve success. Such opportunities are rare, sometimes taking years to materialize. But when they do, they must be pursued aggressively. This leads to Munger's third principle, the power of a concentrated portfolio. Traditional investment wisdom advocates for diversification, spreading investments across numerous stocks. Munger, however, champions a more focused approach, concentrating on a select few businesses that one understands deeply. He believes that this deep understanding can lead to more informed decisions and, consequently, higher returns. A testament to this belief is Munger's own portfolio, dominated by three primary investments: Berkshire Hathaway stock, Costco stock, and a fund managed by Li Lu. John Aralaga's story further underscores this principle. A billionaire investor, Aralaga amassed his wealth in real estate, specifically properties within a mile of Stanford University in California. Over 4 decades, he followed a simple strategy: buy when the market was down and sell during euphoric highs. Despite the myriad investment opportunities available, Aralaga remained focused on his area of expertise, leading him to unparalleled success. As Munger aptly puts it, had he adhered to conventional financial theories, he would have been significantly less wealthy. In conclusion, the investment world is vast and complex, but by adhering to these 3 principles, seeking inefficiencies, seizing golden opportunities, and maintaining a concentrated portfolio, one can navigate it with confidence and success. Subscribe to the channel to learn more about other great investors such as Charlie Munger and Warren Buffett.